If you ever wondered how like those prey investors, they can just glance at a company's financials and immediately kind of get a sense of where they're at like right now and where they might be heading in the future. Well, today we're going to kind of lift the curtain on that process, peel back those layers, and give you a look inside how it's done.
Yeah, that's exactly right. And you've armed us with some great source material here. We've got Vitalhub course, full Q4 2024 financials. We've got the auditor's report, and of course, the always fascinating management discussion and analysis.
Yeah, the MDA, love that.
Yeah.
That's where we really get to read between the lines a bit and hear directly from management about what they're seeing and what their plans are for the future.
Right.
So the mission for this deep dive is, well, it's really to go beyond the numbers, right? We want to pull out those key takeaways from all of these documents, all these different angles, and really figure out what story they're telling us about how Vitalhub performed and what we can maybe expect going forward.
Yeah, and I think one of the first things that jumps out at you when you look at these financials is that revenue growth.
Oh, yeah. I mean, you can't miss that, can you?
No, absolutely not. I mean, in the fourth quarter of 2024, Vitalhub brought in $20.59 million in revenue. Now, to put that into perspective, in the same quarter of the previous year, they reported $13.660 million. So we're looking at a 51% increase year over year. And that's not just a one-quarter phenomenon. If we zoom out and look at the whole year, 2024 revenue came in at $68.59 million. That compares to $52.51 million in 2023. So over the full year, we're still seeing a very impressive 31% growth rate.
Wow. Yeah, those are some big numbers for sure. I mean,
Yeah.
51% revenue growth in a single quarter, that's got to get investors excited. So what's driving that? What's behind those huge gains?
Well, when you dig into the management discussion and analysis, you see that their strategy is really twofold. First, they've got strong organic growth. And what that means is that their existing core business is expanding. Their existing products and services are doing well. But on top of that, they're also bringing in revenue from those strategic acquisitions they've been making. So it's a combination of internal growth and external expansion.
Right. So they're firing on all cylinders, kind of growing from within and adding on through these acquisitions. And, I'm curious about this because they talk a lot in the NDA about like their revenue model.
Yeah.
And they seem to be really focused on shifting towards something they call recurring revenue.
Right, yeah, and that's something you absolutely want to pay attention to because it tells you a lot about the kind of business they're building. So what we're seeing here is a pretty deliberate move away from those one-time perpetual license sales and towards term licenses, maintenance agreements, and support services. These are all things that generate recurring revenue. Think of it kind of like the subscription model you see so much these days, right?
Yeah, exactly. Like instead of just selling a product once, they're providing a service that their customers pay for on an ongoing basis. So how does that break down in the numbers?
So in Q4 of 2024, that recurring revenue stream made up 86% of their total revenue. And if we compare that to Q4 2023, it was 83%. So it's creeping up, and it's the same story for the full year. 83% recurring revenue in 2024, up from 81% the year before. So we're seeing this pretty clear trend. They're moving towards that more stable, predictable income.
And why is that such a big deal? Why are they so focused on this shift towards recurring revenue?
Well, I think there are a couple of big reasons. First and foremost, it just makes their financials a lot more predictable. If you're relying heavily on one-time sales, your revenue can be pretty lumpy. One quarter could be great, the next one could be a dud. But with recurring revenue, you've got this nice, steady stream of income coming in. It makes it easier to forecast your financials and plan for the future. And that stability is something that investors really like to see.
It makes sense, right? If
Yeah.
you're thinking about investing in a company, you want to know that their revenue is going to be consistent and reliable. Okay, so they're growing revenue like crazy. They're shifting towards this recurring revenue model. Let's talk about their profitability. How's their gross profit looking?
So their gross profit did increase, which is good. But the gross profit margin, and that's the percentage of revenue that's left over after covering the direct costs of providing those services, that actually dipped a little bit. In Q4 2024, the gross profit margin was 81%, down from 83% in the same quarter of 2023. And for the full year, we saw a similar small decrease from 82% in 2023 down to 81% in 2024.
Okay, so a slight decrease in gross profit margins. Is that something to be concerned about?
Well, not necessarily. I mean, the first thing to remember is that they've made a lot of acquisitions. And when you integrate new businesses, it can take some time to streamline everything and find those cost savings. And that's exactly what management points to in the MDA. They say that those acquisitions are impacting the margin in the short term. But the key takeaway here is that they're very focused on improving those margins over time. They're looking for synergies, ways to make those combined operations more efficient. So it's something to watch, but it's not necessarily a red flag.
Got it. So short-term pressure on the margin because of those acquisitions,
Yeah.
but they're working on it. They expect to see improvements in the future. All right, let's move down to the bottom line. What about their net income?
Well, the net income picture is a little bit mixed. In Q4 2024, they reported $0.79 million in net income. Now, that's down a bit from the $0.94 million they reported in Q4 of the previous year. And if we look at the full year, net income came in at $3.0 million in 2024. That's down from $4.55 million in 2023.
Interesting. So we've got revenue that's going way up, but net income is actually decreasing. What's happening with their expenses that could explain that?
Well, there are definitely some big increases in key expense areas, and I think those are really important to understand. Let's start with general and administrative expenses. Those rose to $5.44 million in Q4 2024. Now, if we compare that to Q4 2023, it was only $2.91 million. So we're talking about almost doubling their G&A expenses in a single year. And the full year figures show a similar trend, $15.45 million in G&A in 2024, up from $11.77 million in 2023.
So that's a pretty big jump in their overhead. Is that a concern?
Well, management addresses this directly in the MBA, and they basically say, look, this is kind of normal after you've done a bunch of acquisitions.
Right.
You've got to integrate those businesses, you've got to combine systems, and you've got all these additional administrative costs that come along with that. It takes time for those cost savings to kick in. It's not like you flip a switch and it all just magically works together perfectly.
It makes sense. So it's those integration costs that are driving up those G&A expenses. But what about sales and marketing? I mean, they're growing so quickly. So are they spending more on sales and marketing to fuel that growth?
Well, here's something interesting. If you look at their sales and marketing expenses as a percentage of their revenue, they actually went down a little bit. So they're actually becoming more efficient at acquiring new customers.
Okay, so that's a good sign, right? They're getting more bang for their buck when it comes to sales and marketing. What about research and development? Are they investing in new products and services, trying to stay ahead of the curve?
Oh, absolutely. R&D is definitely a priority for them. In Q4 2024, they spent $4.19 million on R&D. Now compare that to Q4 2023, it was $3.19 million. So there's definitely an upward trend there. And for the full year, R&D expenses rose to $15.23 million in 2024 from $12.17 million the year before. So they're putting their money where their mouth is when it comes to innovation, which is a good thing. In this industry, you can't afford to stand still. You got to keep pushing forward.
And that's where R&D comes in. So increased spending on R&D, that's a positive. But we also saw some pretty big costs related to all those acquisitions, right?
Yeah, you can't forget about those. Their business acquisition, restructuring, and integration costs were a big factor in that net income decrease. In Q4 2024, those costs came in at $2.59 million. Now compare that to Q4 2023, it was only $0.31 million. That's a huge jump. And we see a similar story if you look at the full year, $5.21 million in 2024 versus $1.53 million the year before. And those expenses cover all those costs that come with doing an acquisition, right? Like due diligence, legal fees, and then the actual costs of merging those teams and systems.
Right. So when we see that net income dip, we've got to keep in mind that a lot of it is because they're making these strategic investments in growth.
Yeah.
They're spending money to acquire these companies and then integrate them into their operations.
Exactly. They're playing the long game, right? They're not just focused on maximizing profit in the short term. They're building for the future. And speaking of building for the future, there's another metric we need to talk about, which is their annual recurring revenue, or ARR.
Yeah, ARR, that's one of those buzzwords you hear a lot in the tech world. But could you give us like a simple explanation of what it actually means? Like if I'm just starting out trying to understand these financial statements,
Yeah.
what is ARR?
Absolutely. ARR basically tells you how much predictable revenue a company expects to generate over the next 12 months based on all those existing contracts they have for their recurring revenue streams. It takes all those subscriptions, those term licenses, those maintenance agreements, and it annualizes them to give you this snapshot of how much recurring revenue they have locked in. And for companies like Vitalhub that are really focused on this recurring revenue model, ARR is a super important metric. It gives you a sense of the health and the stickiness of their customer base.
Okay, so it tells you how much revenue they've got coming in the door without having to go out and win new customers all the time.
Yeah.
And how's Vitalhub doing on that front?
Well, their ARR is looking pretty good. As of December 31st, 2024, their ARR was $71.05 million. Now, compare that to December 31st, 2023, when their ARR was $44.57 million, and we're looking at a 59% increase. So they're clearly doing something right when it comes to attracting and retaining customers who are willing to sign up for those recurring services.
A 59% jump in ARR? That's got to be making investors happy. What's driving that growth?
Well, if we look at how they're breaking it down in the MDA, it really comes from three main sources. First, you've got organic growth. That means their existing customers are spending more, expanding their subscriptions, adding on new services. Then, of course, you've got the contribution from those acquisitions we talked about. They bring their own ARR to the table, which gets added to the total. And then there's a small positive impact from foreign exchange rate fluctuations, but that's relatively minor.
Okay, so a mix of internal growth and external expansion, just like we saw with their overall revenue. But, we can't just gloss over those acquisitions. They made 4 acquisitions in 2024 alone, right?
That's right. In 2024, they completed 4 acquisitions. Premier IT Partnership Limited, MedCurrent Corporation, Bookwise Solutions Limited, and Strata Health Solutions, Inc. And the total consideration for those 4 acquisitions was $50.10 million.
Wow. So can you give us just a quick rundown of who those companies are and what they do? Like, why did Vitalhub decide to buy them?
So Premier IT focuses on workforce planning and optimization, specifically for healthcare organizations. So helping hospitals and clinics manage their staff more efficiently. Then you've got MedCurrent Corporation. They offer clinical decision support software, particularly for medical imaging. So that's all about helping doctors make better decisions based on the images they're looking at. Bookwise Solutions, they provide scheduling and resource management software. Again, a lot of focus on the healthcare industry there. And finally, Strata Health Solutions, they're all about improving patient access and navigation across the entire continuum of care.
So these acquisitions seem to be pretty aligned with Vitalhub's existing focus on healthcare technology. They're just expanding their reach, adding new capabilities to their platform.
Exactly. And it's not just 2024. Don't forget about the acquisition they made in early 2023, Coyote Software Corporation. They were acquired in January 2023. And Coyote specializes in tailored software solutions for health and social service organizations. And the financial statements for 2024 go into a lot of detail about the consideration paid for both Coyote and the 2024 acquisitions, and how the purchase price was allocated to all the different assets and liabilities they acquired.
Yeah, and one thing that jumps out in those financial statements is the mention of goodwill. Now, I know that's an accounting term, but can you explain it in plain English? What does goodwill mean in the context of these acquisitions?
Sure. Goodwill is basically the difference between what Vitalhub paid for these companies and the fair value of their identifiable net assets. So it's that extra amount they paid on top of the tangible assets they acquired, minus any liabilities they assumed. And it often represents the value of things that are harder to put a precise dollar figure on, like the acquired company's brand reputation, their customer relationships, any proprietary technology they have that's not fully reflected on their balance sheet, and the expertise of their team. It's basically the premium paid for the intangible value they bring to the table.
Okay, that makes sense. It's like the value of the whole being greater than the sum of its parts. You're not just buying the assets, you're buying the potential, the reputation, the people, all that good stuff. So they've been spending a lot of money on these acquisitions. What does their overall financial position look like after all this activity?
Well, one thing that stands out is their cash position. As of December 31st, 2024, they had $56.57 million in cash and cash equivalents on their balance sheet. That's a pretty big jump from the $33.48 million they had at the end of 2023.
So where did all that extra cash come from?
Well, they had a bought deal public offering during the year, which brought in a lot of cash. Plus, they've been generating cash from their operations. And here's another interesting tidbit. After the fiscal year ended, in January 2025, they completed another bought deal offering and raised approximately $34.5 million in gross proceeds. So their cash position is looking pretty healthy.
But lots of cash on hand. That gives them a lot of flexibility, right?
Yeah.
What about their liabilities? Any debt to worry about?
Well, as you might expect, their total assets and their total liabilities both went up during the year because of all those acquisitions. But here's the good news. As of December 31st, 2024, they had no outstanding debt under their credit facility. And they're in compliance with all their debt covenants. So their balance sheet is looking pretty solid.
Okay, so that's all really encouraging. But I mean, no business is without its risks, right? What are some of the risk factors that Vitalhub highlights in their management discussion and analysis?
Right. It's super important to look at those risk factors because they give you a sense of what could potentially go wrong, right? And Vitalhub is very transparent about this. They lay out a bunch of risks, starting with the fact that their operating results can fluctuate. One quarter could be great, the next one could be a little softer. It's just the nature of their business. Then there's the competition. The healthcare technology sector is crowded. There are lots of companies vying for those same customers.
Yeah, it's a competitive space for sure.
Yeah.
So anything else that stands out to you in terms of risks?
Well, given that they're so focused on acquisitions, they're very upfront about the fact that those acquisitions might not pan out as expected. Integrating different companies can be really tricky. Sometimes the cultures clash, sometimes the technology doesn't mesh, sometimes the expected cost savings just don't materialize. So that's definitely a risk to keep in mind. They also talk about the reliance on key personnel, which is something you see with a lot of growing tech companies, right? If they lose a key executive or a top engineer, it can have a big impact on their business. And of course, they mention the broader economic environment. If the economy slows down, their customers might have less money to spend on their products and services. And, they're operating internationally, particularly in Sri Lanka, so they're exposed to risks like political instability, currency fluctuations, and even things like bribery and corruption, which they specifically call out in the MDA. And then you can't forget about cybersecurity. They deal with a lot of sensitive healthcare data, so a data breach could be really damaging.
Okay, so a lot of potential headwinds. They're not shying away from those risks. But before we wrap up, I want to touch on one last thing that I always find kind of interesting in these financial statements, which is the section on critical accounting estimates.
Yeah, that's a good one. It's a little wonky, I know, but it's really important. Basically, it's all about those areas where management has to make judgments and assumptions when they're putting together the financial statements, because there's no perfectly precise answer. Like, how much is goodwill really worth? What's the useful life of that piece of equipment? What's the likelihood that we'll collect on this receivable? Things like that.
Yeah, it's all about those gray areas where there's no easy answer.
Mm-hmm.
So what are some of the key accounting estimates that Vitalhub highlights?
Well, they list a bunch, but some of the big ones are goodwill impairment testing. So basically, every year they have to look at the goodwill on their balance sheet and decide if it's still worth what they paid for it. They also have to make a lot of judgments about the fair value of all those assets and liabilities they acquired when they did those acquisitions. And then there's income taxes, always a fun one. They have to estimate their future tax liabilities, which can be tricky depending on all the different tax laws and regulations they have to deal with. And then there's stuff like the useful lives of their long-lived assets, like their equipment and software. How long are those things going to last? It's not always easy to say. And then there's the valuation of share-based payments, estimating credit losses on those receivables, determining their functional currency for foreign operations, estimating incremental borrowing rates, and accounting for contingent consideration related to acquisitions. It's a whole lot of judgment calls.
So the takeaway for me is that those financial statements, they're not just a bunch of hard, fast numbers. There's a lot of estimation and judgment involved in putting them together.
Right. And that's why it's so important to read the notes to the financial statements and the management discussion and analysis, because that's where you get the context and the explanations behind those numbers.
Absolutely. Okay, so to wrap things up, we've taken a deep dive into Vitalhub's Q4 and full year 2024 financial performance. We've seen some really impressive revenue growth, fueled by both organic expansion and a string of strategic acquisitions. They're moving aggressively towards this recurring revenue model, which should make their financials more stable and predictable going forward. And they're investing heavily in research and development, which is crucial in the fast-paced world of healthcare technology.
Yeah, and you can't forget about their strong cash position. That gives them a lot of flexibility to pursue future growth opportunities. But we also have to keep those risk factors in mind. They're not sugarcoating the challenges they face, which is a good sign.
Absolutely. Transparency is key. So as we leave this deep dive, here's something for everyone to think about. Vitalhub is clearly committed to this strategy of growth through acquisitions, and they're laser-focused on building up that recurring revenue base. So the question is, can they pull it off? Can they integrate all these different companies successfully? Can they keep those new customers happy and coming back for more? And what are the key things we should be watching in their future financial reports to see if they're on track?
Yeah, that's the million-dollar question, right? Only time will tell, but it's certainly going to be interesting to follow their journey.
Absolutely. And that's a wrap for this deep dive. Thanks for joining us.
Yeah, it was a pleasure. Thanks for having me.